Hi everybody, this screencast covers the ITC January 2014 paper 3. This was a fairly unusual 100-mark auditing question. The intention of this screencast is to help students practice using reading time effectively and to practice reading and interpreting a scenario. Let's have a look at the question. You are an audit trainee at Dimco Auditors Inc. and part of the team on the external audit of Cement for Construction Group Limited, also known as CFC. Your firm has been the auditors of CFC and all its subsidiaries for the past 5 years. Okay, so we have quite a lot of experience with this company. And is currently busy with the year-end audit of the group for the financial year end 30th of September 2013. Overall materiality for the audit of consolidated financial statements has been set at 20 million rand, with performance materiality of 14.5 million rand for the account balance of inventory. Okay? So they've lowered the performance materiality specifically for the account balance of inventory. The audit is currently in progress and the following completed program steps and work papers are available. Have a look at those work papers. Obtain an understanding of the group and its environment. We've got 3 work papers there. The first one, B100, understanding the group and its environment. B200, extracts of notes to the consolidated financial statements. X600, a Days of Business article, 14th of October 2013. Then there's also some documentation on obtaining and reviewing the minutes of meetings of shareholders and those charged with governance. X201, extract of minutes of CFC board meeting, 25 of September 2013. And then obtain an understanding of the group's internal control activities, which is N110, a system description for the sale of cement. If we have a look at the first document, obtain an understanding of the group and its environment. For the background, CFC was established in 2006 by a group of entrepreneurs to explore opportunities in the construction during the boom in the property market prior to South Africa's hosting of the FIFA Soccer World Cup. Okay. So they've been in existence for about 7 years. CFC Cement Pty Limited, also known as CFC Cement, a company within the group, acquired a cement plant and started operations in 2006. And the group has since expanded its activities to include the production of aggregates, metallurgical grade lime, burnt dolomite and limestone. CFC and its subsidiaries currently operate throughout South Africa and in a number of African countries. Okay. Guys, when you see a question start talking about groups of companies, it can be very useful for you to draw a little diagram on the side. So in this case, we know that CFC owns CFC Cement. Following the acquisition of a 26% stake in CFC by the Public Investment Corporation in 2008, the company's shares were listed on the JSE in 2009. Okay. Whenever something is listed, there are specific listing requirements, and this is a risk. Okay. Also, the fact that the company is in a group of companies is a risk because of all of the consolidating transactions and the complex consolidation accounting. If we have a look under governance, the board of CFC consists of 5 directors, being the managing director, the financial director, and 3 non-executive directors, of whom 2 are classified by the board as being independent. If we have a look at that sentence, we can pick up immediately that the majority of the board are non-executive and the majority of the non-executive directors are independent. Thus, it's all in line with King 3. The chairman of the board, Mr. Gerling, is an industry expert and spends 50% of his time on the business of CFC. The board has accordingly classified him as non-executive but not independent. Okay. Guys, what you need to pick up from this sentence is that this chairman spends half of his time at that specific company. This is too much time spent on one client for him to be classified as non-executive. So that classification is incorrect. Okay? He is an executive director. The remuneration of the executive directors and key management is determined by the company's remuneration committee, and a substantial element of performance-related pay is linked to profit and sales targets and share price movements. Okay. Guys, what this tells you, any performance-related pay immediately gives incentive to management to misstate the financial statements. Okay. When performance is related to share price movements and the company is listed on the stock exchange, there is incentive for management to manipulate the financials to make the share price increase. In addition to this, you need to pick up that the remuneration is determined by the remuneration committee. In terms of the Companies Act, Section 66, the remuneration needs to be determined by the shareholders on the basis of an suggestion by the remuneration committee. Okay, so now we have a Companies Act issue, and you want to note that in your column. So we'll just put there Section 66. Guys, you can use your reading time to go and look at the Companies Act if you have enough time. What I suggest you do is make a note of this. If you remember that there is something about this in the Companies Act, make a note in the column. You can even write Companies Act rather than the section number. And then towards the end of your reading time, go and quickly look up the requirements in the Companies Act. Okay. If we carry on with this paragraph, the Remuneration Committee also determines the remuneration of non-executive directors, which consists of a fixed monthly fee and fees for attending board and committee meetings. That's in line with King 3 and the Companies Act. If we have a look at the group structure, guys, in this question they've drawn it out for us very nicely. If in a question you don't get a diagram representing the group structure, please do take the time to draw a diagram that you will be able to work with. It's much easier to work from a diagram, get the information quickly when you need it, than go and read through paragraphs to find the information. In terms of question or point 4, business processing and IT, the group's accounting and IT functions are centralized at a service center at CFC's head office in Midrand. To reduce the cost of data warehousing, certain data are stored utilizing cloud technology. Okay. Guys, this is a bit of a risk because the company then doesn't have full control over that data. Okay. You'll have picked up from this page that there's quite a lot of risks that we've picked up. We've picked up a risk in meeting listing requirements, a risk in non-compliance with King 3. There's a risk in the fact that it's a group of companies. There's a risk of non-compliance with the Companies Act. There's a risk here because there's incentive to misstate the financial statements. Okay, so there's quite a lot of risks, and you can go and note those in the column, because from reading this question you should be able to pick up that there's quite likely a required dealing with assessing the risks. Under point 5, CFC Cement is subject to an investigation by the Competition Commission into price fixing. Right, so we have a Competition Commission. This is again a risk because of fines, possible fines or penalties that the company may need to pay. Right, the Competition Commission into price fixing and cartel behavior by the main cement producers. In its application for leniency to the Commission, CFC Cement confirmed the existence of a cartel to divide the market amongst the 4 big cement producers. CFC Cement has stated that as it is a small player in the industry, its involvement should be considered separately. CFC Cement further confirmed to the Commission that the company properly sanctioned its financial director, Mr. Batting, who was apparently aware of these practices. The CFC Cement continues to cooperate with the Commission's investigation. Guys, as soon as you see that there is a CA or an RA in a question, you need to consider whether or not that person has acted unethically. Okay. So in this case, we are looking at a possible CPC question because Mr. Batting was aware of these allegations or this practice, and he went along with it. Okay. If we look at 5.2, 5.2, CFC acquired 1 million of its own shares from the general public and certain directors on the 1st of August 2013. So this is a share buyback. We know that that's a Companies Act issue. We'll probably have to deal with Section 48 of the Companies Act. Okay. The total amount paid to acquire the shares was 28 million rand, and this amount has been deducted from the retained earnings within shareholders' equity. We need to consider whether that deduction has been correctly captured in terms of the Companies Act. This was authorized by the board at its July 2013 meeting. 5.3, a quarry in Botswana was acquired by CFC Cement from Quarries Limited in October 2012. The transaction was valued at 38 million rand, of which 18 million rand was paid during the 2012 financial year. The outstanding purchase consideration is payable in equal installments on the first and second anniversary of this transaction. Okay, 38 million rand and equal installments that you need to know about here. 5.4, the CFC group of companies experienced severe financial difficulties. Now we have a going concern risk. You need to pick that up immediately and make a note of it in the column. Going concern, and it's a huge risk. Severe financial difficulties during the year as a result of an extended slowdown in infrastructure expenditure in South Africa. Serious labor problems and strikes experienced at various operations further contributed to the financial difficulties, resulting in a significant expected loss for the group for the 2013 financial year. Okay. So we have strikes, we have labor problems, we have an expected loss, okay. Major going concern, weakness here. Number 6, other matters. The group's accounting policies conform to the International Financial Reporting Standards, IFRS, and subsidiaries conform to the IFRS for SMEs. The next work paper is an extract from the consolidated financial statements dealing with PPE. They talk about the depreciation rates and the balances. Guys, don't spend too much time in your reading time looking at the specific balances. Just note what they're about and quickly skim through them and see if anything massive jumps out. Also, in this working paper, we've got the balances of inventory. Okay, we're not going to spend too much time looking at that until we know what we're asked to do. Then the next work paper is this article from the Days of Business on the 14th of October 2013. Now we know that our year end is the 30th of September 2013, so this is a subsequent event. You want to quickly make a note of that. Quite easy, we now know they're going to ask us about the subsequent event. Let's read the article. CFC Cement settles cement cartel case. The Competition Commission reached a settlement with CFC Cement today in which the latter admitted that it took part in the cement cartel. Since early 2012, the Competition Commission has been investigating cement producers for their possible involvement in the price fixing and market division. CFC Cement has agreed to pay a penalty. We've got to pay a penalty of 150 million rand, which represents 6% of its turnover for the period in which the practices took place. Okay. Guys, we just discussed it's a subsequent event. The penalty of 150 million is what we have to pay. We know the amount. What you would need to discuss in the question is whether the events that caused this 150 million rand penalty took place before or after year end. CFC admits that it entered into agreements and arrangements with other cement producers to divide the market through allocation of market shares and indirectly fix the price of cement. In terms of the settlement with the Commission, CFC Cement has further agreed to refrain from engaging in this conduct and to develop and implement a compliance program for all of its employees. The Commission has filed an application for confirmation of the settlement agreement with the Competition Tribunal. CFC Cement has indicated that it will not oppose such confirmation of the settlement agreement. Okay. If we have a look at the next work paper, it's an extract of minutes of CFC board meeting, 25th of September 2013. So this is just before year end. The financial performance. The financial director presented the consolidated group cash flow forecast for the next 12 months. Okay, so we have a cash flow forecast looking into the following financial year and expressed serious concern about the group's ability to pay its creditors and remain a going concern. We identified on the first or second page that we have a major going concern risk. This is giving us a lot more information. There has been a dramatic increase in the inventory and debtors and a decline in cash flows. The situation was worsened by labor unrest and the resultant loss of production. Having deliberated on the seriousness of the situation, the board decided to implement the following actions to ensure the group remains a going concern. The credit control function will be strengthened. An extra senior credit controller will be appointed to follow up on and collect long outstanding debts. A portion of the debtors book will be sold to ABC Finance House in a securitization transaction. This will generate cash inflow of 80 million rand by the 30th of November 2013. And then point 3, in March 2014, CFC will undertake a rights issue of 20 shares for every 100 shares held at a discount of 10% of the current share price. The Public Investment Corporation will be asked to underwrite the rights issue. This is expected to raise an additional 45 billion rand. From this page, we can tell that we will probably be asked to audit the going concern, to consider whether this company should draw up its financial statements on the going concern basis or not. In view of the above transactions, the board of CFC is confident that the group will continue to be a going concern and that enough cash will become available to restructure the business to ensure a return to profitability in the near future. Then the last work paper we're going to have a look at is the systems description for the sale of cement. Management control. The sales division of CFC Cement is under control of the sales manager who monitors daily sales by means of reports produced by the system. Okay, so there's a sales manager. He does do some monitoring of reports produced by a system. At group level, the financial director monitors monthly sales budgets and forecasts. So we have some management looking at the reports. The sales option, either in bags or in bulk sales. Cement is sold in bags of 20 kilos or 50 kilos. When a purchase order is received from a customer, it is captured, credited, vetted, and approved, and then is sent electronically to the central warehouse from where the cement bags are dispatched. One of the available drivers of the company's delivery trucks receives a copy of the approved order, which is presented to the warehouse dispatching staff. On receipt of the order, the warehouse dispatching staff load the truck and prepare a delivery note on the system. 3 hard copies of which are handed to the driver. 1 copy is signed by the driver, stamped by a security guard, who checks all the goods in the truck against the delivery note before the truck leaves the premises through its only exit gate. This copy is then sent to the accounting section for processing and invoicing. On receipt of the cement, customers are required to sign the 2nd copy of the delivery note, which the driver returns to the accounting section. The 3rd copy of the delivery note is retained by the customer. For bulk sales, deliveries are done in bulk with the cement supplied to customers in 35-ton payloads. Payloads are transported in CFC cement branded tankers to sites and pumped into customer silos. On receipt of a customer order, the same approval and dispatching processes are followed, except as noted below. The cement is pumped into CFC cement branded tankers. When the tanker leaves the premises, it's weighed at a weighbridge to confirm the 35-ton payload, and the delivery note is stamped as confirmation by a security guard. The capacity of each tanker is 35 tons. There's a system for following up on unprocessed sales. The computer system carries out a comparison of all orders with the delivery notes generated on a weekly basis and produces a printout of outstanding orders, which is then followed up by the sales manager. Okay. So we have a printout and it is followed up. Guys, when you have a systems description in a test or exam, such as this, you can be asked either to identify the weaknesses or to test or to identify the key controls and test those key controls. Okay? Or you can be asked to discuss the control risks inherent in this scenario. Okay? So when you see that you are going to be reading a systems description, keep that in mind. You're either looking for key controls, you're looking for weaknesses. Okay? If you're asked to discuss the control risks, you're actually looking at both. What is good about the system as well as what are the weaknesses in this system. Okay. Let's have a look at the required. Question 1 of the required. The first part, identify and describe the risk of material misstatement in the 2013 consolidated financial statements at the overall financial statement level. So we're looking at risk at the overall financial statement level. So let me highlight that. Risk at the overall financial statement level. Okay, 15 marks. Then for the other 10 marks, part 2 of part A, briefly describe a possible audit strategy. And they go on to describe what they mean by an audit strategy, an overview of the nature, timing, and extent of the audit procedures and resources required, which would respond appropriately to the risks identified in part 1. Okay. When we went through the scenario, we did identify quite a lot of risks. So what you would need to then think about is what can you do as an auditor to mitigate or respond to those risks. Part B, with reference to work paper B100, guys, work paper B100 was understanding the group and its environment. write a letter to the Managing Director of CFC in which you note possible non-compliance by CFC and its subsidiaries with the Companies Act, as well as any concerns you have with regarding the ethical conduct of CFC Cement's financial director. Okay, guys, we did identify that there was a possible CPC issue in the scenario. That's coming through there. The non-compliance with the Companies Act is in terms of the remuneration that wasn't being approved by shareholders, as well as the share buybacks, possible non-compliance with share buybacks in terms of Section 48. Then Part C, with reference to Work Paper B200, Work Paper B200 was the extract from the consolidated financial statements. You're asked to identify risks, again, risks of material misstatement. So these are not audit risks, risk of material misstatement related to PPE, okay, and intangibles. Guys, so this question we're looking at risks at the assertion level related to all of the assertions. So no assertions have been specified here, but relating to PPE and intangible assets. Part 2 asks you to design and document the substantive procedures to verify the valuation of inventory reflected in CFC's consolidated statements of financial position. Guys, with a question like this, one of the very big risks is that you will answer Part B, the substantive procedures, on what they're talking about in Part 1. Okay, so you need to make sure you read the required very carefully. And in Part 1, we're dealing with the risk relating to PPE. Part 2, we're looking at substantive procedures relating to the valuation, because so here they specify which assertion, and we're looking at inventory. Okay, so please make sure you pay particular attention to the wording of the required. In Part D, discuss the control risk for each of the assertions of occurrence, accuracy, and completeness relating to the sales of cement. Okay. So we're looking at control risk. Here we're looking at what is the control weaknesses, okay, which you've seen often in questions before, but you can also discuss what are the good controls in this question. Okay, what are the key controls that are working in this particular scenario? Then Part E, assuming the audit has to be finalized by 31st of January 2014. Describe the substantive procedures, again, you would perform regarding the appropriateness of the going concern assumption underlying the 2013 consolidated financial statements. Okay. And then Part F, discuss the treatment of the settlement with the Competition Commission in the 2013 and 2014 consolidated financial statements of CFC. So here we're having a look at, is this a subsequent event? Does it need to be adjusted for? And what adjustments are necessary? Okay. Guys, I'm going to stop there. I would suggest that you now go and attempt this question on your own and have a look at the solution. If you do have any questions on the question or solution, you are welcome to come and ask me.